Thanks, Malcolm.
Thanks. And the black.
Great. It's wonderful to see many of you again. A lot of you, I think we had a chance to speak last year, and if not, hopefully after the presentations this year. So as Stuart said, I'm going to give a bit of an update just on kind of the state of play of the market and the portfolio. I'm also going to talk a little bit about how we go about finding winners, especially in a market like this, where a lot of things are potentially overvalued, and it's quite a heady market. I've apparently got the wrong clicker.
You have, okay, that's where the clicker went. So it's that one.
Okay.
There we go, that's where it was.
There we go, okay. So just a little bit of kind of state of play, i.e. what are we experiencing on a day-to-day basis? It's a really busy market, and we'll see that when we go to talk about deal flow, but there are a lot of companies raising money. I don't have a specific answer as to why this is the case, but I think a number of it is kind of fallout of, if we go all the way back to 2007, 2008, 2009, people started founding businesses when they ran out of banking jobs or other jobs, and a lot of those businesses have come into their own. I think there's also an increasing culture of entrepreneurialism as a career, whereas that didn't really exist 6 to 10 years ago. And there are a lot of kind of celebropreneurs. Everybody knows who owns Facebook, who owns Twitter, who owns Google. And I think that inspires a lot of younger people to start businesses. But for whatever the reason, we're seeing a lot more activity in the market. And that includes a lot more people starting businesses, but a lot more investment. Following from that, valuations and competition remain high. And competition comes in a lot of forms. It can be other private equity firms, other VCs. There are a lot of family offices and angels and super angels that we come up against. There isn't really one consistent sort of key competitor for us. One of the other things I would say is that this is a huge market for frenemies in that we're all competing with each other, but we are also all syndicating. I think all but one of the deals we did this year was a syndicated deal, and the average check sizes are getting bigger, which I think is a good thing for the companies because it gives them a bit more runway and a bit more ability to compete with either US or domestic companies. But it means that we are having to syndicate because the initial check sizes are getting bigger, so we are tending to spread the risk. The portfolio is incredibly robust. And I think as Malcolm and Stuart both touched on, it's a pretty benign environment. We are starting to see some cracks, but it's a pretty benign environment. We're benefiting from that across the portfolio. We're also having a great period of exits. And one comment I would make on the exits, we have had a couple of people say, well, isn't this a good time to kind of clean up the portfolio and get rid of the things that aren't the best performers? The market is aggressive and the market is willing to pay, but the market is not stupid, and they're willing to pay for great performers. So what we're seeing is that we can get great valuations for great performing companies, but people aren't hungry for underperformers. Going back to the robustness, I'm also happy to say we really don't have a lot of underperformers right now. The portfolio is doing generally quite well. Of course, we have the odd things that aren't going well, and I think we might see more of them as we see more cracks, but for the moment, things are going very well. Following that, we are getting ourselves kind of both mentally prepared and otherwise for some kind of a market correction. I don't want to try and call exactly when it's going to happen or how severe it's going to be, but I will talk a little bit about the things that we're doing to be ready for that. This is just a couple of the things from this year, and luckily it goes in this lovely 4, 5, 6, 7 sort of circle. We've had 4 businesses again showcased in the Sunday Times Fast Track. Some of those are old favorites. Dianomy would be a new addition. 5 exits, which I'm going to touch on again in a little bit, but the average IRR across all of these was 25%. And there was obviously, Stuart mentioned Third Bridge, which was a phenomenal exit for us, but the rest of them were also very strong exits. So we've had consistently good exits. For those of you who were here last year, you might remember it was a similar story last year, and we do see the environment being very similar in that there is a lot of money and people are willing to pay. 6 new investments and 2 more in WIP, and then we've got 7 follow-on investments and 4 more that are also work in progress that we hope to complete before the end of this year. Just on the new investments, we've got kind of a picture of all of the new investments that you've seen a little bit earlier this year. I'm going to shortly talk about how we go about finding these investments, but one of the things that I would say is we are working a lot harder because we're not necessarily willing to pay the prices that the market wants for new investments. So we've seen deal flow up significantly in the last year, but the number of deals we're actually doing has gone down. The average check size we're writing in a first-round check is getting bigger. So we're putting more money behind the companies that we see as being successful options and options that we're willing to pay for. And the same thing is true for follow-on investments. We are writing bigger check sizes for the follow-on investments in order to back the winners in a stronger fashion. This is a bit of an update from one of the things we touched on last year. We are often asked about the process and how do you go about finding the winners and validating the businesses. I'm not going to go through this in great detail, but I will go through an overview of it. The other thing I would say is we have a lot more processes, checklists, documentation, significant debates at the investment committee level that goes into this lovely chart, but I'll try and kind of summarize it so that we can give an overview. On the left here, we take a look at where do we find the deals. 2016, the majority of our deals came from intermediaries. These are professional introducers like corporate finance houses, lawyers, and accountants. In 2017, you can see there's quite a shift there. We're seeing a lot more deal flow coming from other venture capital and private equity firms. Part of that is because there are quite a lot more early stage incubators that are acting as feeder funds into the VC community. And part of it goes back to that syndication theme, where we're writing bigger checks on the initial check size, which means we are sharing a lot of deals. Just going through the processes, and I'm not going to go in great detail, but deal flow, as I think I mentioned earlier, is up 30% on last year, and that's good quality deal flow. So we've seen over 1,000 deals that go through this process of an initial piece of analysis where we check, is the management team qualifying? Is there enough revenue for us to be interested? Is it a sector we're interested in, et cetera? If so, it goes on to our deal flow record, which we actually keep in our CRM system. That's discussed at the investment committee meetings we have every Monday. It's a high-level discussion at deal flow where people give feedback initially, thoughts, do you know somebody who could be helpful? Have we tried this investment before? Have you seen something similar? So that's our initial filter. If it gets past the deal flow in a couple of initial meetings, we start doing more due diligence. This is an internal process where it'll be usually somewhere between 2 and 5 meetings with management, and then a lot of review of financial statements and models. If we still like it, we then go to what we call fast forward stage. This is where the management company comes in to present to the entire investment committee. We also do a short paper here to solicit general feedback. We then go to the terms and due diligence stage, and this is where we negotiate a term sheet with the management team. If we're able to reach terms, we continue to have ongoing meetings with the management team. We're also doing due diligence such as calling customers, suppliers, referencing the management teams. We then go to our final internal stage, which is about a 20 to 30-page investment paper, which gets debated in usually quite a heated and lengthy way at the investment committee level. And a lot of the things we bring up are how can we make this investment better? How can we make sure that this investment is highly successful? We then go to third-party due diligence, and third-party due diligence is bringing in accountants and lawyers to do quite a bit of review of the businesses. And I have just noticed an error here because the number that go to third-party due diligence, I think, is a carryover from last year. I think we had 10 that went to third-party DD this year, of which we closed 8. So we lost 2 in that process. The closing, or the 8 that we did this year, I would highlight that last year that number was 10. So while deal flow is up 30%, we're doing fewer deals. And that goes back to the idea of, are we willing to pay for some of the prices? I'm next going to talk about what we look for those 8 that actually get to closing. And this is a huge oversimplification, but hopefully gives some color. The most important thing is the team. We would rather back a great team in a mediocre industry than a mediocre team in a great industry. And that's true over and over again. A couple of the things we look for, track record and experience. If we're looking at a founding team that's relatively young, we can augment that team with non-execs or execs who do have the experience. But experience might be they've worked in the parallel industry for a very long time. Or in an ideal situation, they're a serial entrepreneur who has done something similar over and over again. An open and honest team, the only thing that we know when we make an investment is that it's not going to go according to plan. It will either be better or worse. We need a team who's going to be working with us and open and honest and not just pitching us all the time. Confident and willing to listen, and somebody who's able to attract great people. That's usually a wonderful indicator. And then an incredible amount of personal drive and ambition. Traction for us, generally at the time we invest, revenues are 1 to 20 million. We always want to see historically rapid growth. And then cash management and capital efficiency. We know that they're going to spend the money wisely. The opportunity, proven product. And for us, this doesn't just mean commercial traction. We call the customers and suppliers and reference to make sure that people are getting the kind of return, the kind of benefit they think they will from the product. Clear USP, and obviously a significant market size to tackle. And then lastly, and this is one of our differentiators, I think, we do have quite a strong focus on profitability. And for us, we would much rather see a company spend the money we've invested, go into a bit of J-curve, and then come back out of it to break even, and then we can make a decision to invest in the next wave and the next wave. What we don't invest in is long-term sustained losses. We aren't looking for investments where we're always dependent on the next guy to put a check in and keep the business alive. Excuse me, I'm about to cough too. And what I would say on that one is, 4 or 5 years ago, a lot of the entrepreneurial community was looking for go big or go home. They wanted big checks, they wanted huge ambition, and they were intending to go into long-term losses. In the last 2 to 3 years, I would say that's changed a little bit, and people really like our story. There are more and more entrepreneurs who like the idea of invest, show that it works, invest again, show that it works, rather than having to take a check for 50 to 100 million and then make a 5 times return on that for somebody. So we've had very good response to kind of our story and our pitch. I'm now going to talk a little bit about when things go wrong, or what things can go wrong, or what things we're worried about. And we're often asked, tell us about a business that went wrong. We're going to avoid that because most of the businesses, or all of the businesses, continue to trade, and it actually doesn't help us to talk about things that go wrong in a business that's actively trading. So instead, I'm going to talk about this year the things that keep us up at night. And I'm going to be quite honest about it, as I should be, but I would preface it by saying we do feel quite confident. The portfolio is doing well, we're exiting very well, but we're always thinking about the things that we should be worried about. So at the moment, what keeps us up at night? Valuations. We touched on that a couple of times. We're working quite hard. We're being highly selective in the things that we're investing in. We're putting more money to work in the things that we like, and we're putting more money to work in the existing portfolio. An impending market correction. I think we're all pretty confident there is going to be one. One of the particularly positive things, we were speaking to a wealth manager, quite a successful one, yesterday, who said amongst his clients, this is the most hated bull market in history. That's actually quite a positive thing in our view because it says people are ready for it. It's not just a run on the market. People have, in his case, he said most of his clients have been waiting for it since 2009. So there is a sense of people getting ready for it, which is helpful. We don't know what the depth and breadth is going to be, and we don't really know what Brexit and Trump are going to do for us. The biggest thing and the best things that we can do, with regards to Brexit, we are very conscientious about FX exposure, and we're managing that within the companies. We're also concerned about the ability to attract European talent, and we are making more investments throughout the EU and helping the portfolio companies make sure they have an EU presence. But the biggest thing we can ever do is to make sure the companies have strong balance sheets. That's the one fallback that is always the safest bet. If you've got a strong balance sheet and you're able to weather that storm, then you come out stronger the other side. And I would say right now is quite a good time to be raising money to shore up the balance sheet. And we are doing that across the portfolio. We're concerned about certain vulnerable sectors, and I'm sure I'm preaching to the choir here when I say a single sector always has knock-on effects if things go wrong. And Malcolm mentioned consumer. That's an area we are concerned about, and the consumer credit right now is at an all-time high, and wages are still lower than 2008. So there is going to be a problem in the consumer market, which of course will have knock-on effects into things like advertising and software services. And then the last bit, I'll just make a quick comment on, when I say leverage, it's not specifically us, because we don't tend to use much leverage, but I don't know if you've heard much about venture debt, which is an instrument that we really didn't talk about 3, 4, 5 years ago, but is prolific now. And it's effectively providing debt to companies that are too early stage to be bankable, with the idea that the private equity firms, the VCs, are going to be helpful in supporting the businesses if things go wrong. There are situations in which it makes lots of sense, but we believe right now it's a bit overused, and we're going to see the cracks in the venture debt system if things start to go wrong. Obviously, problems breed opportunities. We have been through this a few times. The funds are nearly 30 years old. 2 of our existing portfolio companies, Watchfinder and Bliss Media, were both trading in 2007, and both of them managed to continue growing through 2008-9 and came out the other side with a much more market-dominant position. So when there is a market correction, we separate the superb businesses from the pretty good businesses, and we believe we're invested in quite a few superb businesses, which could lead to an opportunity for them to be in an even better position. This is a great time to continue selling and shoring up the balance sheets. I touched on that. And then the last bit of it is we're kind of all chomping at the bit for this to happen to get it over with, but also because it's the best time to invest. We think we will start to see the valuations come down within the next couple of years, and hopefully we'll have enough dry powder to take advantage of it. that's it for me. I'm now going to introduce, do we have Johnny and Daniel? Great. Johnny and Daniel from my first years, who are two absolutely dynamic and really, really strong founders, we believe meet all that criteria that we spoke about earlier. And they are going to talk about their business, My First Years, which might be made most famous by the royal family being significant fans. But I'll let them do most of the talking. Thank you.